Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Jeffrey Faustin of Jenson Funding Partners to talk about the Jenson SEIS and EIS funds. Hello Jeffrey, welcome back to the studio. For those who aren't familiar, can you give us a bit of background to Jenson and your own experience?
Hi Jonathan, thanks for having me back. Yes, so Jenson Funding Partners is an early stage venture capital fund. We have two funds on the market right now. We've got an SEIS fund and an EIS fund, and we've been around for 10 years since SEIS started. In that time, we've backed 128 SEIS companies. We have a follow-on fund, the EIS fund, and through that fund, we've also followed on to 30 of those companies to date. So far, we've had 10 exits across those funds. And we are now looking to expand our portfolio with a new round of investments. My role in Jenson is as the Chief Investment Officer, but I started back in 2013, 9 years ago, as an intern actually. And I have done every role you can think of since then. And I'm now the Chief Investment Officer and I'm a partner at Jenson Funding Partners.
So we're here today to talk about the SEIS and EIS funds. What do they aim to do for investors?
Well, predominantly, we aim to deliver brilliant returns to our investors. We are targeting a 3x return on both the SES and ES funds. And the way we do that, Jonathan, is we look to find companies that have really innovative IP and try and get at least a 10x return individually in those companies with an expectation that some of those companies will fail and some of them will survive and return the entire fund.
So starting with the SEIS fund then, what are you looking for in investee companies within that fund?
Specifically with the SES fund, we look for companies that have really disruptive IP and a backable team. And what I mean by those two things is that we look for companies with IP to solve a real world problem, and then we look for teams that have domain expertise predominantly, but also a well-balanced team and have the skill sets within them to do the next stage of work within that that offering. And also, and more importantly, teams that actually listen to advice. That's really important for us.
So how early are you investing? I know SEIS is obviously the first ticket into a company typically. How early stage do you go?
We are very early stage. We are probably one of the early stage funds in the market. We typically come in pre-revenue at an MVP level. We tend not to do
minimum viable product.
Minimum viable product. Yes, sorry. We tend not to do too much pre-product investments, so typically at that first inclination of some product market fit is when we're coming.
So how are you sourcing all of these investments?
Having been around for 10 years, we have built up a quite extensive network of deal flow. We currently see in excess of 2,000 decks a year, and that comes from incubators, accelerators, universities, within our own network, but also, and quite interestingly, we actually get good deal flow from founders themselves. We've actually had a few investments now that have been made off of introductions from founders that we actually turned away. But because of our process, we stayed connected with the founders and we've got deal flow from that. So quite a few sources.
You then have the EIS fund. What are you looking for in terms of investee companies for that fund?
So our EIS fund adopts a follow-on strategy. And what that means is that we tend to support and back our existing asset portfolio companies. What we try to do with the EIS fund is we try to invest at a very early stage along that growth curve of a company. Now, because we work very closely with these companies, we have a very good understanding of the ones that are actually achieving their objectives. So we can get in very early into those companies that are going to be successful. So a lot of the companies that we invest in through the EIS fund are actually from our SES portfolio.
So typically, what does it take for a company that's already received SEIS backing from Jenson to then graduate into the EIS fund? Yeah,
it's an interesting question. The way we currently structure it, companies that take a follow-on fund investment from Jenson, it really depends on the stage they're at and the number of times we follow on. So the very first follow-on investment, what we're looking to see is that company starting along that growth curve, so understanding their market fit, understanding their growth metrics. Those are really key indicators for us. And as they grow, we want to see that natural progression along that growth curve, really refining those metrics. So it depends on how many times you've invested, But generally, we want to see that kind of journey along that growth curve.
Okay. And is the current environment affecting the way you invest? And how is it affecting the companies you're backing?
Not directly. Because of the way we invest in companies that predominantly have a really sustainable business model. So we invest in companies that must try and get to profitability. So within the current environment, what we've seen is companies who have been investing on a more aggressive growth strategy where you've literally just funding to maintain growth without any sight of profitability. Those companies have kind of suffered in this environment. Because we inherently invest with a more, I guess, conservative approach, we haven't really had that impact. Where it could potentially impact on our companies is for later stage funding. There may be a focus on the existing portfolio for those later stage funds to support them, then come into our companies. But because our companies are profitable by that stage, we can afford to wait for the right opportunity.
Okay. And can you tell us about some examples of recent investments you've made in the funds?
Yes, sure. We've seen one of the most recent investments we made is one called Sküma Water. So Sküma Water is a hardware company that has designed a new way of doing reverse osmosis, and they've applied that to a water filtration system. So they've come up with their own water filtration system to purify water that is 4 times more environmentally friendly than current systems. But in addition to that, they've also developed some additives. So you have electrolytes and other additives that they add back, so that they can now offer various different types of water, if you like, flavored water as well. So that's a new one that we've just invested in.
Was that SEIS?
That was SES, yes. I was at SES level.
Do you have any EIS examples?
Yes, we have recently approved an investment which is a follow-on investment to a company called Axioma.
Yep.
So Axioma is a marketplace for smart repairs. It's where you have, if you've got a really minor repair in your vehicle, you've got a mobile repair unit that comes out to fix it. So they've created a marketplace platform where they have mobile repair units that you can access, depending where you are regionally. When we first invested in them, they were doing, really, really minor revenues. They have 10x their revenue in the last year. Since we put our SES money in, they now want to grow and scale out into a B2B side of the business where they kind of target, fleet managers. So we've now looked to approve an EIS investment into those guys.
And so you mentioned at the start you've backed over 100 companies now. What about some of the more mature holdings in your portfolio? How are they performing? Any particular highlights?
So one of our more mature companies that we've backed a while ago is a company called QRoutes. They provide a routing technology for local authorities to help disabled people get access to school, and try and have a more efficient way of getting that and reducing routing costs. We backed them 6-7 years ago now, and they haven't taken any more money since we put our SES cash in, but they've more than 10x their revenue since then, and are now looking to launch into America. So that's an example of one that's doing extremely well. It's hard to put a value on that because they haven't done a valuation event, a liquidity event, but yes, they're doing fantastically well.
Sounds very good. And so to what extent do you get involved in these companies after you've invested in them?
So we are very hands-on in how we deal with our portfolio companies. We have at least regular monthly meetings with the companies we've recently invested in, and that tends to that cadence tends to extend with time. So most companies that are later stage, more longer invested, we now look at doing quarterly meetings with them, but we are very, very hands-on. A lot of the support we try to provide our companies is around growth, strategic growth support, and how to grow. We're an agnostic fund, so we don't really bring that sector expertise within our team, the core team. We have third-party support that kind of help to add that in as and when it's necessary. But predominantly, we sit on the board of most of the companies we invest in, either as a director or as a board observer, and we try to add that value in that way. And
what about exits within the funds? Any exits you can speak about?
So we've had 10 exits to date. The most recent exit we had was 2 months ago, and that was from a company called OneTouch Telecare. They got bought out from a private equity firm called August Equity. Unfortunately, we are not allowed to say how good a return that was, but it was an extremely good return for us, having been the first money in. And all I can say is it almost returned the entire fund for us, which is a great example of our model at work.
So I guess you must have backed that at SEIS stage.
So we backed that company at SES stage back in 2016. And we did a co-investment with Enterprise Ireland at that time. And then they were able to raise a small round from angel investors in between that since then. And now, most recently, yes, they've now exited through that private equity fund.
And is that typically what you'd hope for? Is that there's one name within an SES portfolio that might return the bulk of the returns?
So yeah, that's precisely the model. What we try to do is have, what we expect is to have 20 or 30% of our portfolio return the entire fund, return the actual fund plus deliver the target returns for our investors. We actually expect roughly about 60% of our portfolio companies to deliver no returns at all. And that's, apart from the loss reliefs that the SES funds allow. So, part and parcel of what we do is to try and make sure that we understand which companies will deliver return, and those that we can't see return being generated from, try and as quickly and as efficiently as possible generate the loss reliefs for our investors. But for those that are actually achieving their targets, we see the bulk, that's where we concentrate the bulk of our effort in trying to support those 20 to 30% of portfolio companies.
So it's pretty high risk then. And for a typical investor looking at these funds, how risky would you say these funds are, and what's the key difference between, say, the SEIS fund and the EIS fund? You said, I think, a 60% failure rate
yes.
for SEIS.
Our target returns are actually the same for both funds, and the reason is because of our follow-on strategy. If you think about it, we invest into, let's call it 10 companies, expecting a 10x return from each company, but expecting 60% to fail. So 20%, so 30% will deliver that 3x on that. And that's the SES strategy. Within the EIS follow-on strategy, what you find happening is that because we are only supporting those companies that have done well, we will be supporting them, but at a higher valuation because you're investing along that growth cycle. So those EIS companies, we actually expect to have a lower return, probably somewhere between 5 and 10x return on an individual company basis, because you're backing the same companies that are going to do well, but at a higher price, effectively. But then because you are no longer backing the companies that aren't doing well, you have a high proportion of EIS companies that you expect to generate a return from. So the net of it is that we still expect roughly a 3x return from both the SES and EIS. For an investor looking to invest in either SES or EIS, I think it comes down to their expectation or their appetite for loss, because with the SES fund, you have more losses within your portfolio. And I think a point to note is that the SES losses come before the returns. You typically will find your SES companies falling away within its first 6, 9, 12 months of the investment. So investors have to understand that within the SES fund, yes, there's more tax reliefs, but you will have a larger portion of your portfolio that will not generate returns. And I think you need to understand that and be comfortable with that when you're choosing between SES and EIS.
That's a very good point. And so to sum up then, Jeffrey, for those who want to invest in an EIS or SES fund this year, why should they invest in the Jenson funds?
We have the longest running SES fund. So we feel as if we really understand that space very well. Our EIS fund is a follow-on fund, so we support the same companies that we invest in through the SES fund. I think that, and we've had 10 exits to date, so I think that demonstrates that we understand the market and we know we have a model that we believe works. We've proven that it works. I think those are the two key reasons why I think investors should consider us. We are very early stage, and I think if you consider investing across a range of SES and EIS companies, investing with Jenson kind of covers that early stage nature. There are later stage funds, and if you want to diversify your portfolio, I think it does make sense to include Jenson as part of that. The other thing, of course, is that we don't charge any fees to investors, so that's always a bonus.
So that makes the tax reliefs a little bit more efficient.
It makes it just that much more efficient, yes.
Jeffrey Faustin of Jenson Funding Partners, thank you very much.
Thank you, Jonathan.
If you are watching on YouTube, please press like and subscribe to the channel for more.